Union Bank of Switzerland lost a lot of money doing what it thought was a riskless trade. And then they were forced by their bank regulator to write a whole big report about how they managed to lose all this money. And this is on the web, and everyone can read it. And it is great. It's very, very informative. I have the URL in the notes here. It would be a better world, okay, if the US securities regulators had required Citibank to write such a report, okay, had required, all the banks that got some help from TARP, okay, to write such a report. Explain to me how you managed to lose so much money. Well, the Swiss regulators did this to UBS. So we know exactly what they were doing, and we know how they got into trouble, okay? And here's what they were doing. They were involved in arbitrage, okay, using credit default swaps. They weren't dealing with corporate bonds. They were dealing with mortgage-backed securities and with CDO tranches of mortgage-backed securities. But those things are very much like they're risky securities, just like corporate bonds. It noticed, in effect, that the spread, S, on the bond was not the same as the cost of insuring against default on that bond, or at least not the price that it could get that insurance from AIG. So what they did was to buy a AAA, these were AAA to begin with, AAA CDO tranche, okay? So this is AAA rated, and the underlying securities behind this are mortgages. Subprime mortgages in some case, but they've carved off all they claim to have carved off all of the credit risk and put it into low tranches. And so what's left is rated AAA by Moody's and so forth. And they bought those outright. Okay. Their regulators in Europe said, I know it's rated AAA by this American company, but if you want to use this, okay, if you're a bank and you want to have this on your balance sheet and you want to use this as collateral for borrowing, which is what they did, you have to buy some insurance against it, which they did from AIG. Okay, so and other people in this business too. So they bought a credit default swap. So that's like double insurance. They bought the highest tranche, so there's all these lower tranches that are going to absorb all the losses. That's the idea. And then they bought insurance against that one too. So it's like double up. And then they did money market funding on this side. Meaning they used this security as collateral for borrowing in the money market in asset-backed commercial paper or repurchase agreements, one or the other. Okay. Remember at the beginning of the lecture when I said my definition of shadow banking is money market funding of capital market lending. That's exactly what's going on here. Money market funding of capital market lending. This is a security here, okay, that trades in the capital market and has a price. Okay. So it was shadow banking in that sense, but it was on the balance sheet of Union Bank of Switzerland. So it wasn't in any particular shadow. Okay. It was right there, sitting on their balance sheet. When Citibank did things like this, they put them in a separate little facility, a structured investment vehicle, a special SIV. SIV stands for, I think, special investment vehicle. And it was off their balance sheet, so you didn't see it. Okay, but in UBS, you can see it. It's right here. And they thought they were in fine shape. They thought they were doing something called a negative basis trade. That's what they call it in their report, negative basis trade. Which is to say that when you put this whole thing together, you do this deal, you buy this thing, you insure this thing, okay, and then you borrow money against it here, okay, there's money left over. There's money left over. And there's money left over today, and apparently every period from now till the life of this thing, which of the CDO tranche, which is, there's mortgages there, so there's 10, 20 years worth of this. So they took this money that was left over for the next 20 years, and they said they booked that whole thing as profit today. Every time they did a trade like this, they said, we now have 20 years worth of profit, okay, which we're going to book today and pay bonuses today, okay, on the basis of that profit. They weren't the only ones who did this. A lot of people did this. But then what happened was there began to be some little doubts about the value of this AAA CDO tranche. It fluctuated in value just a little bit. Okay? The credit default swap should have fluctuated in value the other way, right? Should have gone the other way. That was all very fine and good, but the problem was that this fall in value caused problems for rolling over this funding, because this is collateral for this funding. Not this. The credit default swap is not collateral for the funding. This was collateral for the funding. So they couldn't roll over their funding. And when you can't roll over your funding, what do you have to do? Okay? You have to sell the underlying asset. But if you sell the underlying asset, that pushes the price down farther. So you can see you get into this kind of liquidity downward spiral thing that goes on. Because they weren't the only one doing this trade, there were other people doing this trade. And by the time they were doing this trade, they were no longer, by the end, okay, they were no longer buying insurance from AIG, which was a very solid insurer, believe me, okay? But it charged a lot for this insurance. And because it charged a lot, eventually this was no longer a negative basis trade. So they started saying, well, you know what? These things are so good that we won't actually insure the whole value. We'll just insure against a 2% fluctuation. And if it fluctuates more than that, we will eat it ourselves, okay? So we'll only buy insurance against moving from 100 to 98. And if it moves below that, we'll take the tail risk ourselves, okay? So when it moved below 98, they had all that tail risk, okay? So this is the way so this is the important point to emphasize. They felt themselves to be taking no risk at all, okay? And they lost billions of dollars. And it was because they had they had assumed that they would always be able to roll their funding, and they were not able to roll their funding. Yes?
While they still were getting CDS from AIG, would it not have been in the best interest for both the short-term lenders and for UBS to renegotiate such that the CDS could also be collateral for the repo?
Well, you might. Okay, this is a good question. Okay, so let me just repeat the question because I have a microphone. Saying, well, wouldn't it have been in their mutual interest for the people who are doing this funding to say, why don't you give me this as collateral, or why don't you give me this package as collateral? Now, one reason possibly that you're imagining that is because you're remembering the world of Badgett, okay, where we had the bills and we had the acceptance on the bills, and they were attached to each other, okay? And here, they're not attached to each other. They're separate securities, okay? Maybe in some future world, okay, we will have that. In this world, we did not, because this money market funding is from a mutual fund, okay? Mutual fund that has regulations about what it can accept as collateral. And certainly, CDS is not something that it can accept as collateral. You know, it has to have a proper security. There's a lot of regulations on the kinds of things that are acceptable. So this was just not on. It was, I mean, it might have been a good idea, okay, and it might still be a good idea. In fact, you may have been, one of the things I proposed exactly when AIG was failing was what the government needs to do, okay, is to step in and write credit default swaps, okay, because I understood that credit default swaps are sort of like an acceptance, okay, and that's what you need if you have a liquidity problem, okay. You need somebody to write acceptances, and they didn't do that. So that's how they lost their money.